Call options explained. Say you want to buy a house, but you don't want to buy it until a date in the future. You and the seller come up with a price that you both are comfortable with. Let's say $100,000 to make it easy. The seller will ask for a non-refundable deposit, let's say $1,000. And you both agree that the purchase date is 6 months out. You have until that date to purchase this house, but you are not obligated to buy it. What you are obligated to do is pay the deposit and it's non-refundable. Now let's say in 6 months the house is now worth $125,000. You can now finalize the purchase and they can't make you pay any more than the $100,000 plus the deposit. Note, the deposit doesn't come off the purchase price, so essentially you have made $24,000 on the deal. Now let's say in 6 months the housing market crashes and the house is only worth $75,000. You don't have to buy the house but you'll be out the $1,000 deposit, since it was non-refundable. But the option to buy the house is only good until the set date you agree on. In stocks this is called the expiration date. Let's look at how this works in the stock market. Should you decide to do the stock equivalent of buying the house, it is called exercising the option. Each call option that you buy will be a bundle of 100 shares. So in order to make this contract you will be paying a small amount per share, say $1 per share, and you will never get that $100 back whether you exercise the option or not. What most retail traders do is trade these option contracts with each other, as in, they don't actually exercise them. So say the house from before, halfway to the expiration date, so 3 out of 6 months, is now worth $125,000. The trader can either hold the contract for another 3 months to see if the house will be worth more, or they can sell this option contract to someone else for them to buy the house, and the trader selling will get a little extra of course, so now the new buyer will be paying for the original non-refundable deposit plus a little extra, usually double the original deposit. So the retail trader sold the options contract, made a profit, and is no longer involved in the contract. Rinse and repeat. Some other notes on call options. There are ETFs in Canada and the US that handle all these call options trades for you, and split the money with you in the form of a dividend, often paid monthly. These types of ETFs, known as covered call ETFs, generally have yields ranging from 6 to 10%, and sometimes higher. I personally own HUTL on the Toronto Stock Exchange and PAYF on the same exchange, and both have held their value through these recent hard times, as of the summer of 2022 at least. I would note that despite the high monthly yields, covered call ETFs are not expected to greatly increase in value over time, so in a bull market, there could be much greater potential for overall gains in growth stocks. Over a long time horizon, there may be better potential for gains in general index funds which have historically averaged higher returns, although not necessarily by a huge margin. Always remember to do your due diligence and choose the investing pathway that is best for you. This channel provides general knowledge for your research purposes, not financial advice. May the market force be with you.
Add the Canadian Financial Survival Channel to your list of weapons. Subscribe, like, win.